Thank you very much, Trevor, and welcome everyone. So what I'm going to do today is I'm going to discuss the current case for holding South African bonds in your portfolio and trying to answer the question, is there currently value within the fixed income market in South Africa? So I always find in answering this question, the best place to start is having a look at our current universe. So what we've done here is we've graphed the current South African government bond yield curve in red at the top. And what you can see by looking at this yield curve, so you can see time to maturity at the bottom and then yields on the y-axis. So if you look at the x-axis, if we were to invest in a South African government bond today that matures in 10 years' time, and then have a look on the x-axis, the y-axis, you can see that the 10-year bond is currently trading at around about 11%. Now, there are two observations when we have a look at this yield curve. The first one is that you can see, looking at SA bonds, that currently you can get much higher yields for investing in longer dated bonds, sort of 10-year maturity plus, trading at 11 and 11.5%, relative to cash rates, which are trading at 5.5%. So the curve is currently very steep. And also yield curves change over time. So if we graph it relative to the blue line, which is what the yield curve looked like 3 years ago in 2019, you can see that our current curve is a lot steeper and yields are a lot higher. So is there value or is there not value? As a fixed income manager, I always like to bisect the curve, the yield curve, into two key components. The first one is looking at yields that mature in, say, 3 years or 4 years or 5 years, where I have some visibility on what the current interest rate cycle looks like. So as an example, right now, cash rates in South Africa are 5.5%. I think that rates are going to be, they're going to rise further to maybe 6.5%, maybe 7% before the Reserve Bank stops hiking in this cycle. Whereas if you look at the yield curve, we could invest in a 4-year bond that was currently trading at a fixed rate of 9%. So much higher than that 7% that I currently think will be the peak in the interest rate cycle. So for me, there's clear value in the shorter end of the curve. Things get a little bit trickier when you go further out along the curve. So if we're trying to value bond yields of, say, 10 years plus, there are other factors that drive bond yields in the longer end of the curve that aren't only related to the near-term interest rate cycle. So what are those factors? Once again, we're talking about a 10-year bond yield trading at 11% in South Africa, much higher than cash rates at 5.5%. So there's clearly quite a large risk premium priced into the curve. But is it attractive enough? And to answer that question, we need to answer 3 big valuation questions. The first one is, what do we think will happen to global bond yields? Now, South Africa is a small part of the big global bond universe. Within that universe, the center of the universe, which is really, you can imagine it's the financial sun that the rest of the bond universe revolves around, is what we think of as our benchmark rate, or US 10-year treasury bonds. And we need to determine, do we think that global bonds driven by US 10-year bonds are moving higher, yields moving higher, or yields moving lower? The second question that we need to answer is that we're investing in South African bonds. So what additional risk premium do we require for investing in bonds that will carry South African inflation risk over the next 10 years instead of US inflation risk? And the third valuation pillar is that, once again, these are South African bonds issued by the South African government. So we're looking to the SA government for repayment of our bonds over time instead of the US government. What additional risk premium do we require for taking on South African specific credit risk? So let's have a look at some of these drivers and charts, starting with global bond markets. Now, the theme in global bond markets at the moment, as we all know, is inflation, inflation, and some more inflation. And we can see that by having a look at this chart, we've graphed US CPI over many years. The US Federal Reserve targets an average inflation rate of 2%, and you can see that inflation has moved within quite a narrow band around that 2% for a very long time. But obviously that changed recently. Now, there are reasons why inflation has surged globally since COVID. 3 main big global inflation shocks that have hit the economy. The first one was coming out of COVID, pandemic-related inflation, where we saw supply chains really break down because the world was shut down and restarted again very, very erratically. So goods were being produced erratically and being transported to the end markets in a very different way. Supply chains were frankly just broken. And at the same time, we had lots of demand. So households were protected, people didn't lose their jobs, corporates were protected. And some markets, like in the US, literally sent a check to every single man on the street and said, you can buy whatever you want with this money. But there was nothing really to buy because there weren't any services to spend your money on. So all this demand was chasing very few goods. And as we said, those supply chains were broken. So that was global inflation shock number one. We then saw earlier this year what we call as conflict inflation. Russia invaded Ukraine, oil prices shot sky high, and Ukraine, a very, very important global food producer, particularly wheat and seeds, and we saw global food inflation move higher. Didn't stop there. We then had a third inflation shock with China, with their zero COVID policy, shutting down big parts of their economy at different points in time this year. And we saw this third wave of inflation impacting supply chain shocks even further. So all of those came together to have this inflation print where we now have US inflation at around about 9%, highest it's been for 40 years, so very, very dramatic. Expected to come down. You can see the dotted lines in the forecast, but there's a lot of uncertainty around this. What has the Federal Reserve in the United States done with interest rates? Well, they very much had to slam the brakes on. So we've seen interest rates rise in the blue line over here very, very quickly in a very short period of time. So we haven't seen a hiking cycle like this out of the US for a very long time and not expected to stop here. Fed's still guiding that they're going to continue going until inflation has been brought under control. So what does this mean for global bond yields? Well, these factors are both negative for bond yields. Higher inflation, because you're investing in fixed rate bond yields, higher inflation erodes your real return. That should be negative for yields or for bond markets. And secondly, higher interest rates obviously lifts the shorter end of the yield curve and creates considerable uncertainty about where interest rates are going to, particularly for markets like emerging markets. So if we have a look at how US bond yields have then reacted to these forces, we've shown you the US 10-year bond and how that's moved over time. We can see how it rallied or strengthened very strongly into 2020, and since then has unwound all of those gains incredibly quickly over a very short period of time. So US 10-year bonds bottomed around about 0.5%. We always knew that was too low, has unwound all of that and is trading back up at 3% again. Now, we expected this to be a headwind. By looking at SA bond valuations, we knew yields were too low in the US. We knew they were going to have to normalize or rise back to more normal levels again. And that's happened and happened very quickly. In fact, if you looked at total returns out of the US bond market from the 2020 lows until now, that market's returned minus 15% total return. So for bond investors, this has been quite a big story. You don't usually have these types of negative returns on the global stage. What about going forward? So, when we're thinking about the forces going forward and how that impacts the domestic market, we're relieved that a large part of this normalization is done. So we're not out of the woods yet. We think yields might be able to rise a little bit further. This is a difficult time when we don't know when the Fed is going to be finished with their hiking cycle, but a large part of the story has played out. So looking forward, we would give this factor a tick from a valuation perspective. The second factor that we discussed we would need to have a view on is what's going to happen to South African inflation. Now, if we have a look at this chart, we know that our Reserve Bank in South Africa is an inflation targeting central bank. They're mandated to keep inflation between 3% and 6%. They actually target the midpoint, which is 4.5%. And if you look at South African CPI in red over time, it's been very well behaved. So really moving within those two guardrails. Only recently have we moved above the upper end of that 6% target range because of that second inflation shock, which was conflict inflation. Oil prices moved higher, global food prices moved higher, and both of those components are quite a big part of our consumer basket. So we couldn't avoid that. South African inflation has moved up above 6%. It's now currently just below 8%, which is quite high. But looking forward, we anticipate that it will fall back down to 6% again by the middle of next year and then continue to fall back to the target range. So yes, in the near term, still some uncertainty, but if we have to look for longer term perspective, we think inflation will come reasonably comfortably back into the target range again over time. So that's a tick once again from a valuation perspective. The third factor we said we needed to consider was the risk we're taking investing in South African credit risk. So the South African government bond is the issuer. And here we had some good news post-COVID. We know that South Africa is a commodity exporter. And if we have a look at this chart, it shows in the red line the index of our export commodities. For the commodities that we export, the price changes in that. And in the grey line, the main commodity that we import, which is oil, you can see how the jaws between these two lines opened up quite significantly during post the COVID period. They have closed a little bit, but still quite positive levels. So this is still a tailwind for South Africa. We call this a positive terms of trade. This has been very good for a number of different reasons. We've been earning more on our exports than we've been paying for our imports. So it's been very positive for our current account, which has helped offset some of the risks to the rand and the inflation outlook. So we're not immune, but certainly has provided us with a little bit of a shield in this type of global risk-off environment. But most importantly for this discussion is it's been a very important boost for the fiscal outlook. And if we look at that in the chart, here what we've done is we've shown the contribution of the mining sector to government taxes over the last couple of years. And the mining sector has always been an important contributor, generally ranging between 2 to 3% as a share of government revenue. And what we saw in this most recent tax year was the mining sector alone contributed 155 billion rand in both corporate income taxes as well as royalties into the government coffers. Outsized contribution relative to the past, and as much as 10% share of government revenue. This has been a very, very important driver. And when we think about investing in a sovereign like the South African government, one way that we can assess the risk going forward is having a look at that country, how much debt it carries relative to the size of its economy or its debt to GDP ratio, and how we think that's going to change over time. Now, if you think about the COVID period in 2020, we saw government revenues collapse because we saw a huge economic contraction in South Africa and all over the world, but our expenditure increased quite significantly because of COVID-related expenditure. And if we go back to the medium-term budget policy statement in 2020, so we get 2 budget updates every year. We get the main budget in February from National Treasury, and they update us again in October with the medium-term budget policy statement. So in October 2020, we were looking at a picture that looked like this. The National Treasury were forecasting these numbers. Now, for an emerging market, once you go through round about 60% debt to GDP, warning lights start to flash. So lots of emerging markets go through that ratio, but essentially you move into a more vulnerable territory if you exceed that threshold. And what we can see here, the picture we were looking at in 2020 was that we were going to sail right through 60%, and debt to GDP over time was only going to stabilize at 95%, so close to 100% debt to GDP. That was a very vulnerable time for fixed income investors. Fast forward a year later to the midterm budget policy update we got in October 2021, and that forecast period improved quite significantly, largely due to this outsized contribution in terms of mining taxes. The commodity windfall improved these numbers quite significantly. Roll forward to the budget this year, we saw further revenue overruns, and the forecast expected to stabilize around about 75% debt to GDP, a much, much healthier picture. So, one needs to point out 75% is still too high relative to what we would want sustainably over time. For bond investors, what we really need to see to be very optimistic on the outlook is much stronger growth so that we can stabilize our fiscal outlook. So we can't have 1 to 2% growth. We need 2 to 3, possibly even higher, to become really optimistic on the outlook for bonds. But the point to make is that the direction of travel over these past 2 years has been very positive. So let's go back to where we were looking at the yield curve, and we were saying the 10-year point of the curve currently trading at a fixed yield of 11%. We've taken that point of the curve and we've graphed it over time. And you can see that 11% yields are very high relative to what we saw in the past, particularly higher than the pre-COVID period in 2019. So are these yields attractive or not? So we've gone through those key valuation pillars and we've given ticks to all of them to say on a forward-looking basis, we're actually quite constructive on the outlook, but yet we're getting 11% yield. There are 2 very simple rules of thumb that you can use as a bond investor. One is think about that 11% fixed yield and think, what is your real yield going to be over time? So you're investing in a 10-year bond. What do you think inflation is going to be over the next 10 years? We know we have a very credible and committed central bank targeting 4.5% inflation and committed to getting inflation back down to 4.5%. But let's just say that there's a little bit of slippage. Inflation is actually 5% on average over the next 5 years. You're getting an 11% yield, take away your 5% expected inflation, and you're left with a real yield that is 6%. Is that high or is that low? Or think about the mandates that you might give to your portfolio managers. If you have to give someone a CPI plus 2 or CPI plus 3% benchmark, you would see that as a very low risk product. If you were to give a manager a CPI plus 6 to 7%, you would think that's a very high risk benchmark. We'll probably have lots and lots of equities in there. Here you can invest in a government bond over 10 years that gives you a 6% CPI plus 6% real yield. That does sound attractive. Another way of thinking about this is that 11% yield is very high. So 11% yield is a given. We just don't know what yields are going to do over the next year for what our total return is going to be. So we can stress test that. We can say if we can start with 11%, yields would have to move from current levels of 11 all the way to 13%, which is pretty much off this chart, on a 1-year view before my total return as a bond investor over a 1-year period will be negative. That's a very, very high margin of safety because that 11% starting yield is just so high. So summarizing all of that together, we absolutely think that the current environment is one of risk. We've got these global risks, we've got domestic risks, but at the same time, we think the risk premium on offer in the yield curve is very high, very attractive, and we think you're being well compensated for those risks as investors. If we just have a look at, these are one of the portfolios that we manage. It's our very low risk product, the Strategic Income Fund. You can see at the duration arrow at the bottom in terms of where our bond weighting currently is. We are overweight bond allocation relative to what we would say is a medium or neutral weighting. And at the same time, we have a very hefty weighting to South African government bonds, which is the grey carve out, given the clear value that we see as currently on offer in the market. Thank you very much for listening. I'm going to hand back over to Trevor. Thank you.
Mel, thanks for that. Very insightful and interesting. A couple of questions that we've got through here, and I'll kick off with the first one. And that really relates to, I think, where many financial advisors get asked by clients holding cash. And that is, should we put our money into a traditional money market type of unit trust that we know is giving probably around about 4.5–5% yield at the moment, versus a fund like you've just shown yourselves, a more flexible income type fund and you mentioned your yields around 7.5% at the moment. But of course, with that is slightly higher levels of risk and I guess volatility. Can you just perhaps talk to what your views are for a client and again, all relative to that inflation story and a real return that you mentioned? Should clients be holding money in cash, or should they be looking to get that little bit of extra yield in a flexible income type fund?
Fantastic. Thank you, Trevor. That's a great question. So they're both very low risk products, but as we know, a money market fund is at the very lowest rung of the risk ladder. So it depends on what the time period of investment is that one anticipates to invest for. And a money market fund, really, if you think about the differences between a money market fund and this type of fund, is it's just got a much smaller universe and it invests a lot shorter. So it takes instruments out to a year to maturity. And it's mainly bank issued instruments that will be included in the fund. So the types of returns that you get from money market funds would be cash plus a little bit, but not a lot. So small outperformance relative to cash, but given the constraints of its mandate, it would never have the ability to do any more than that. Whereas a flexible income fund has a much wider universe. So it has many more levers that it can pull. So once again, sitting in the lower risk part of the spectrum, but it can invest in longer dated instruments and in a wider universe. So as an example, when we were looking at the yield curve just now, we were saying that you could invest in a 4-year fixed rate bond currently earning 9%, government bonds, not even taking on credit risk, and that's compelling because we think cash rates might peak out at 7%. You could include some component of that in a flexible income fund, but you wouldn't be able to include it in a money market fund given its more limited mandate. So it certainly has more levers, ways it can stretch itself in a fund like this to be able to enhance returns. So it comes back to that time period of investment. If you want to have very low variability in returns, so you have a time horizon of 3 or 6, even 12 months, you probably want to sit in a money market fund where it's more, the variability is going to be very low. It's always going to be cash plus a little bit. Whereas if you can lift your head to a slightly longer time horizon, 1 to 3 years, say, this type of fund, which is a flexible income fund, is a lot more compelling because you're going to get a higher yield over time. Your variability returns might be a little bit more, so you might get cash minus a little bit in some months, cash plus a bit in other months, but overall your returns will be higher, your yield will be higher given the bigger universe, and also you have the potential for some capital gains in the fund as well, which you don't have in a money market fund. So it really comes down to your time period.
Great, thank you. Thanks for that, Mel. Nicely explained there. I think that all makes sense. Just perhaps to end off then, and I think you did speak to it largely in your presentation, but perhaps just to clarify, if we take Laurium, you guys run multi-asset class funds where you're investing domestic, global, equities, bonds, etc. Just in terms of your guys' current house view, where do you have fixed income or domestic fixed income specifically currently? Are you guys underweight, neutral, overweight? What is your guys' house view currently on that asset class?
Fantastic, thank you. So we have an overweight fixed income positioning across all of our mandates. So we run a whole range of different mandates. If we just have a look at our high equity or our balanced mandate, as we are in our other mandates, we're overweight relative to neutral because we do see clear value within the fixed income market. We have said there were some headwinds we were concerned about. One of them was rising global yields. We think that that theme is maturing. We're getting to a point where you've got more conviction that perhaps some of those headwinds are behind us. So we're not completely significantly overweight bond allocation relative to neutral, but we're absolutely long in all of our portfolios. So if you take that balanced fund as an example, our neutral bond weighting would be 15% in SA bonds. We currently have an effective weighting of 20%. So there's quite a big overweight, 5% overweight SA bonds relative to what we would consider our neutral weighting, and looking to add to that over time as these risks become more mature and priced in a little bit better.
Great, Mel. Thank you. That was really great. And thanks so much for joining us today and for your insights. Really appreciate it.
Thank you so much for the opportunity. Lovely to see you. Thank you.